Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Welcome to the September 1st version of the Market Carver. A few topics for this week. We're going to start off with a very important Federal Reserve update and Jay Powell's speech at Jackson Hole. We're going to talk about some impacts on valuations. Look at S&P 500 and the stocks that are either above or below the 200-day moving average, and also talk about the fund flows to energy stocks. So first off, we're going to talk about the Federal Reserve and Jay Powell's speech. So just for some background, each year the Federal Reserve hosts a meeting of global central bankers, and oftentimes it's used to provide critical information or to announce a change in Fed policy. This time was interesting in that Chairman Powell was very succinct, very direct, and very clear. The markets over the past few weeks had become somewhat complacent or had high hopes that the Fed may change their policy of trying to get interest rates up. He made it very clear that they would endure and they would go through whatever pain necessary to bring inflation down. So what I had up on there is a chart of the 2-year yield, and I think that is instructive for really a reflection. There could be a lot of noise around the Fed does. Stocks can have a lot of things input, whether they're going up or down, but the 2-year Treasury rate is very much tied to Fed policy. And you can actually see if it peaked out in late June and eased to the side there. It didn't really keep going up. 2-year yields kind of flattened off, and that embeds this hope that the market had that they would somehow stop rising. But that turned around and changed after the speech from Jackson Hole. When the Fed made it clear. Of course, risk markets have latched on and become a little bit more in tune with that, which means a little bit down in price and respecting that action. So moving down, closely tied to this, we look at the valuations of S&P 500 stocks. And by valuation, when I use the term PE or price to earnings ratio, that is the valuation measure we're using here. We're plotting it against a 2-year yield. So the 2-year yield in this case is inverted, so you can plot the relationship among those two, which have 1994 was another case where the Federal Reserve raised interest rates a lot, and then 2022 in this current. So the purple line is plotting that 2-year yield, and then the black line is the price to earnings ratio of the S&P 500. So if you want to focus in on 2022, this seems really complicated, but the implications are straightforward. So that black line shows you that the price to earnings, the valuations got up there later last year and stayed well above 20, call it 22, 23. In a historical context, that's a very expensive. That is at the upper end of what investors historically were willing to pay for S&P 500 stocks. And as interest rates come down, as interest rates went up, that creates more competition. Investors can park their money in safer money and have a higher yield, and it makes it tougher for stocks. And you can see the impact that's had on valuation levels until as of late. As of late, the S&P 500 had a nice rebound, moving that price to earnings back up to 18 and diverging away from 2-year yield. So you had two different things happening here. You have that divergence that was out there, and then the 2-year yield, which moved on to higher territory. So if this relationship were going to hold, that meant a little bit more pain for the S&P 500, something that we've seen in the prevailing weeks or days since then, playing a little bit of catch up. So that's the fundamental side of the market. Now we pivot to the technicals, Andrew. And by the way, when I say Chartered Market Technician, I know we don't say this enough, but we blow over it. So if you missed the update or you're new to us, Chartered Market Technician is the premier designation for those who look at technical analysis, who look at nothing other than the way stocks are behaving, looking at charts and lines and intermarket analysis. So when we throw the technicals over to him, there's a big reason why he's the one speaking to you about those topics.
Well, thank you, Adam. Well, first of all, we'll pull up the first chart we're going to look at today. And here we have the S&P 500. This is a long-term chart. Some weeks we look really narrow in just the last couple of months. Sometimes we try to look at a lot of market history. This week is one of more of the latter. Here we have the S&P 500 actually going back to the early 1990s. Really wanted to show kind of the historical semblance of what's happening right now and something that hasn't happened actually in quite a long time. So since the start of the year, we've had the market in a pretty rough spot. We peaked in early January, and the market's been kind of drifting lower since then. And how we define an uptrend for a lot of stocks, including for the market itself sometimes, is if it's trading above or below its 200-day moving average. When we have a lot of stocks trading above that long-term average, it tells us the market's pretty healthy. When a lot of stocks are trading below that long-term average, it tells us that a lot of the market is in a downtrend. And what this study that we're looking at today looks at is how long, how long has it been since we had the majority of the S&P 500 trading in an uptrend, trading above that long-term moving average. And we've actually gone, through the end of the last week, it was 88 days. We're recording this video, we're at actually day 90 now. That we've gone 90 days as of right now without the majority of stocks being in those defined uptrends. And that's a really long time. The only time it's been this point or higher was after the dot-com period, during the 2001 bear market, and then after the financial crisis, during 2008. So it's really during these major market declines, these structural bear markets, where we see a protracted period of time of a lot of stocks staying below that long-term average. And the reason I think this is important is it helps us characterize the type of market that we're in. It's now we're moving into September. We've been kind of in this downtrend this entire year, and that's very symbolic of other major downtrends we've been in. This is something that's going to be a lot of agitation for investors. This is nothing new to the market. Downtrends are very much a healthy part of long-term cycles, but we're at a point now where we've really only seen this type of action during prior major downturns, which suggests that maybe we aren't going to see that immediate snapback rally that we kind of got accustomed to after 2011, 15, 18, after the COVID crash, where the market just immediately bounced right back up. It may not be that easy. We're always looking for changes in the environment, and we try to keep an open mind. But currently, we have a lot of stocks that have been below that average for a long, long time. Now, the next chart we're going to look at is yeah, go ahead.
No, sorry for the interruption there. I have nothing really to add other than, these we present to you, as always, the markets as they are. And we get the question from time to time, what do we need to do? You guys are pointing about valuations that are a little bit higher, maybe coming down, and the market technicals don't look good. The whole thesis here, what we're doing is sharing with you our thinking. And it is our job, and we do make transactions on your behalf, go into your account, move accounts to be positioned defensively when necessary. This is simply our way of sharing you why we make the decisions we do. And we play the hand that we're dealt, no matter what it is. So yeah, that's a great job on the technicals. And I think also here, I'll let you pivot back to energy stocks, which have been more important to our portfolios than they have for a long time.
Yeah, excellent point. We do. With some of the news that we've been sharing hasn't been the most exciting and the most positive. One piece of news I think actually is positive for families of FEG is looking at the energy market. This is a place that we've been having exposure for a good chunk of most of this year. Our sector rotation has been in energy for, again, many months in 2022. But what's interesting is when we look kind of below the surface, we can see on a rolling, this chart's looking at a rolling 3-month and then just a rolling 1-month, net flows within the XLE ETF. XLE is the energy sector ETF. And when it's in green, you can see there, it's when we're starting to see inflows. We're seeing more money flowing in to this exchange traded fund. When we go negative and it turns red there, that means we're seeing outflows. Investors are leaving this ETF. What's fascinating is XLE, the energy sector, has been the best performing sector by a long shot in 2022, up over 40%, outperforming the market by about 70%. And what have investors been doing? Have they been running and trying to chase this outperformer in this year? Absolutely not. We've actually seen a rolling 3-month outflow since April. It's really fascinating to see that even though it's been the best place in the market, energy markets have been extremely strong. One of the few sectors that are still actually having good valuations, reporting good numbers, seeing good price performance, and we're still seeing investors shy away from this part of the market. The way we take in that data, what we think this means, and of course this is just our opinion, is that if we do see a chase in the energy in the fourth quarter, if we start seeing institutions and other financial advisors and just the average retail investor start to chase after retail, they have a lot of ground to make up. We're still seeing a lot of money flowing out of the space, not into it, meaning we don't think that it potentially could make the argument that there's not this trend up in energy is not done yet, because we're not seeing that overly confident, over sentiment driven rally in energy. It's just the opposite. So we think that there's still some proverbial juice to squeeze in the energy space, because we're just not seeing a lot of bullishness yet, even though it's been the best performing sector pretty much all year long. And luckily we've been able to have a lot of exposure to it. Is trying to find some bright spots for our portfolio. And I think that's kind of the main take home point, is while maybe the broad market is having some struggles, there are opportunities in different parts of either the equity market, the fixed income market, commodity markets, where we can look for some opportunity for growth. There's a saying, there's always a bull market somewhere, and that's what our job is, trying to find those opportunities when maybe the broad market is less generous, we'll say.
Yeah, when you shared that with us in our investment meeting, I was really surprised with that data. I hadn't seen that, and really would have missed that badly on a pop quiz if I were to guess what had happened. But again, that is, I agree, totally surprising, and we'll take it. I thank you all for giving us a few minutes of your time. We always give you a couple of weekly reminders. The first is to give us a call if you'd like to see us. Maybe get a second thoughts on the portfolio you have if we're not managing it, or if we just haven't seen you for a while, give us a buzz, 800-928-4001. And then lastly, we've got a show on the radio each and every week over the airwaves, WIBC, and in a couple other stations. But we also put that out in podcast form for you to get at your own convenience. So thank you again. This is a weekend where we're heading into college football. So for many of you like me, we'll be enjoying that great piece of kickoff to fall. So thank you again, and have a great weekend.